Hey everyone, welcome back to Corporate Dakota, the place where we dive deep into the financial guts of big companies and spill the tea. Today we're dissecting Latham Group's latest earnings report. And let me tell you, there are some interesting numbers in here that tell a story beyond just the usual business talk. Latham, they're the big players in the swimming pool world, making everything from the pools themselves to the covers and liners that keep them looking spick and span. Think of them as the ultimate pool party architects. Before we dive headfirst into the numbers, if you're someone who likes to see what's really going on behind the polished corporate facade, make sure you're subscribed. And hey, we've built a fantastic community over on our Discord server where we break down these reports even further. You can find the link to join in the description below. Alright, kicking things off for the big picture. Latham Group is reporting for the period ending June 28, 2025. This is essentially their quarterly checkup, giving us a peek into how they're doing financially. It's worth noting that Latham is classified as an accelerated filer, which tells us they're a pretty big company that's been around the block a few times in the public markets. As of August 1st, they had over 116 million shares of common stock floating around. That's a lot of ownership spread out there. Now, let's get to the heart of it all, the financial tables. These are where the real secrets are hidden. First up, the balance sheet. It's like a snapshot of what the company owns and owes at a specific moment. As of June 28, 2025, Latham had about $27 million in cash. That's their readily available money. Their total current assets, which are things they can turn into cash within a year, like inventory and money owed to them, stood at around $21.14 million. They have over $114 million tied up in property and equipment. Think factories, machinery, all the stuff that helps them make their pools. And here's a whopper, they have almost $282 million in intangible assets. This usually means things like brand names, patents, and customer lists that give them a competitive edge. It's a big chunk of their value that you can't physically touch. So their total assets, everything they own, comes out to a massive $22 million. That's a big operation. On the flip side, their current liabilities, the bills they need to pay within a year, are around $90 million. They also have significant long-term debt, a whopping $278 million. This is money they owe that's not due within the next year. It's important to see how they're managing this debt. Adding up all their debts, they owe about $423 million. Now, looking at their equity, they have a huge amount of additional paid-in capital at nearly $468 million. This often comes from selling stock above its basic par value, which is good news for keeping their equity healthy. However, they also have an accumulated deficit of about $65 million. This means that over their history, they've spent more than they've earned, which isn't ideal but common for growing companies. Altogether, their stockholders' equity, the true net worth belonging to the owners, is around $398 million. Alright, let's move on to the income statement, which shows how much money they made and spent over a period of time. This is where we see if all those assets are actually generating profits. For the 3 months ending June 28, 2025, Latham brought in about $173 million in net sales. After paying for the cost of making their products, their gross profit was around $64 million. That gives them a gross margin of 37.1%. That's a pretty healthy number, meaning they're keeping a good chunk of the money from sales after directly paying for what they sold. When they subtract all their operating costs, including things like marketing and salaries, they were left with an operating income of about $25 million. And finally, after all expenses and taxes, their net income for the quarter was around $16 million. That's a 9.3% profit margin, which is solid. Now, here's a metric they like to highlight, adjusted EBITDA. It's a way to show performance before certain big non-cash expenses. They reported nearly $40 million in adjusted EBITDA for the quarter, translating to a 23.1% margin. This is a much higher profitability figure than their net income margin, largely because they're excluding things like depreciation and amortization. It's a good way to show how the core business is performing. Let's look at the bigger picture, the first 6 months of the year. Their gross profit was almost $97 million. This gives them a gross margin of 34.1% for the half year. It's a little lower than the quarterly margin, but still respectable. Net income for the first half was around $10 million. That's a profit margin of 3.5%. So while the quarterly results look strong, the first half shows a bit more of a drag, but it's still positive. Their adjusted EBITDA for the first half was about $51 million with an 18.0% margin. This again shows that their core operations are yielding a better return than the reported net income. Now let's talk about cash. The cash flow statement shows how much cash is actually coming in and going out of the business. Profits are great, but cash is king. For the first 6 months of 2025, they actually used about $11 million in cash from operations. That means their day-to-day business activities, after all the accounting adjustments, used more cash than they generated. They also used nearly $15 million for investing activities, which included buying property and equipment and a couple of acquisitions. That's normal for a growing company. And they used about $3.6 million in financing activities, mainly for paying off some debt and for taxes related to stock awards. Overall, their cash balance decreased by almost $30 million in the first half of the year. This explains why their cash on hand dropped from $56 million to $27 million. It's important for them to manage this carefully. The notes to the financial statements are like the footnotes in a book where all the important details and explanations are found. One of the big stories here is their acquisition of CoverStar Central LLC. They bought this company in August of last year for about $71.5 million. This acquisition is all about bringing more of the supply chain in-house, especially for their automatic pool covers. They bought it to boost their profit margins and expand their market reach. The goodwill from this acquisition alone was over $22 million, which represents the premium they paid over the fair value of the acquired company's identifiable assets and liabilities. This indicates they saw significant value in CoverStar beyond just its physical assets. Looking at their intangible assets again, it's interesting to see how much is allocated to things like dealer relationships and pool designs. These are crucial for their business model. They have nearly $239 million attributed to dealer relationships. That's a massive investment in their sales network and shows how important a strong dealer base is to their strategy. Let's revisit that debt. Their main debt is a term loan of $281.5 million. The effective interest rate on this debt is quite high, around 9.24%. That's a significant cost of borrowing. To manage the risk of rising interest rates, they've entered into interest rate swaps. They actually refinanced one swap in June of this year, fixing their borrowing rate on a large portion of their debt. This is a smart move to try and stabilize their interest expenses. Compensation is also a big factor, especially stock-based pay. They have over 3.5 million restricted stock units outstanding, and they've granted a lot more recently. This is a common way to incentivize employees and leadership by giving them a stake in the company's success. When we look at earnings per share, basic earnings per share was 14 cents for the quarter, and diluted earnings per share were 13 cents. This is a key metric investors watch to see profitability on a per share basis. Interestingly, Latham operates as a single business segment. This simplifies things as all their activities, pools, covers, liners, fall under one umbrella, and their CEO reviews performance on a consolidated basis. Beyond the numbers, the management discussion section gives us insights into their strategy. They're focused on growing their fiberglass pool sales and improving efficiency through lean manufacturing. They also made a strategic move to acquire CoverStar Central, which they expect to boost their automatic cover sales and margins. They're really pushing their Sand State strategy, which targets regions with growing populations and demand for pools. The acquisition of CoverStar Central and smaller dealers in that category is a clear move to consolidate their market position there. They also confirmed that their internal controls are effective. This is important for ensuring the accuracy of their financial reporting. Now let's not forget the risks. They're dealing with general economic uncertainty, consumer confidence, and the impact of tariffs. These are external factors that can always throw a wrench in the works for any company. So what's the story here? Latham Group is clearly a significant player in the pool industry, with strong brands and a strategic focus on growth, particularly through acquisitions and expanding their market share. Their quarterly results look quite good, with solid revenue and net income figures. However, the first half of the year shows a bit more of a mixed picture, with cash from operations being used rather than generated and a hefty amount of debt. They're betting big on their acquisitions and efficiency improvements to drive future profitability. The high interest rate on their debt is a point to watch closely, though their interest rate swap should provide some stability. The significant investment in intangible assets, especially dealer relationships, highlights a sound strategy focused on building and maintaining a robust sales network. The company is navigating a changing economy, so keeping an eye on how they manage their cash and debt will be crucial. Alright, that's our breakdown of Latham Group's latest report. What do you think about their strategy and their financial performance? Does the acquisition of CoverStar Central seem like a smart move? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into the corporate world. And don't forget to join our Discord community linked in the description. Thanks for watching, and we'll catch you in the next Corporate Duto. That like button and subscribe for more deep dives into the corporate world. And don't forget to join our Discord community, linked in the description. Thanks for watching, and we'll catch you in the next corporate world. And don't forget to join our Discord community, linked in the description.